In today's video, we are doing a fundamental analysis on AMC. This company is currently up by 15% today, folks. We're going to load this up first into Yahoo Finance to take a look at the earnings for the last 4 quarters. And it's a little bit of a mixed bag here, as you can see. For the Q4 2021, it was met. First 2 quarters of 2022 were both missed, and then Q3 was beaten. Bring this over to the stock spec software here. We are currently ranking this company a 3 out of 10. For those who are new here, this software essentially takes a look at the company's financial statements and essentially grades it so you have a better idea of where this company stands financially. So over the next 5 years, you can have an idea if this company is worth hanging on to or not. With AMC, currently ranked 3 out of 10. Let's figure out what they're doing right and what they're doing wrong. For the things that they are doing wrong, one is their current ratio. And I'll just pull up that screen here now. Their current ratio is currently 0.42. We want to find companies that have a current ratio of 1.5 and higher. That it would indicate to us that they have enough assets on hand, plus some extra, to cover those liabilities in case economic times get a little bit hard. And ultimately, that's what we're trying to find here, folks. We want to find companies that have some sort of longevity. So with a 0.42 current ratio is not very healthy for AMC. Their EPS growth is actually in the negative. So their EPS has actually been going down over the last 5 years. So we don't want to see that. We want to see earnings per share going up, as well as their debt to equity is in the negatives. So it's not that they're funneling the company through debt or through equity, but being in a negative number. But essentially, there's a lack of shareholder equity, folks. This is something for you to be concerned about. If you're trading this company, it's one thing. In this channel, we are all about investing, long-term investing, value investing, to be more clear. So when you have a debt to equity in the negatives, the lack of shareholder equity is a major concern. The share dilution over the last 5 years have gone up by enormous amounts, so 112% increase over the last 5 years. Now look, this is due to the hype surrounding the stock. It's no stranger to that. When GameStop was going up, AMC was the next in line, and you can see by the surge in stock price, people were loving the stock. So why wouldn't they fund equity, or why wouldn't they fund any kind of business relations by issuing out more stock? People like this company, right? People are going to buy the stock, and it's evident here. Look, April 2021, a close of $9.78, and then it got to a high of $60.73. Absolute madness. So that's why there's so much share dilution. But then you go down the categories here. The net income is down into the negatives. The free cash flow is in the negatives. And their return on invested capital is also in the negatives. However, the revenue growth is up. So they're getting a point from there. So there's a lot of red on this board. I'm not too thrilled about that. But the revenue growth has gone up over the last 5 years. And we'll go to the balance sheets afterwards. But their price to earnings ratio is also low. Something to keep in mind. That's we want to find companies that have a price to earnings ratio of 22.5 and below. However, you take a look at the company metrics category here, and the trailing 12 months price earnings ratio is in the negatives, guys, where on average it's 13.27. Not liking that at all. Not liking that at all. The return on equity is 40.51%, which is great. We want to see a high return on equity, and even in the trailing 12 months, it is currently sitting at 34.27. So these are relatively high numbers. So overall thoughts on AMC, it's a fairly weak company, but you bring it over to their cash flow statements and stuff like that, and here's where I really stand by my point of it being a weak company. You go down to the free cash flow line of the cash flow statement. It's currently, for the 2021 year, it was negative $706 million. Prior to that, in 2020, negative $1.3 billion. Let's take out 2021 and 2020 years, because obviously those years are a little bit of a write-off because of the whole pandemic. Prior to that, going 2019 back to 2012, it's been a very much so of a rocky, bumpy ride for this company. You had negative $2 million in 2012, then a huge jump up to $96 million in the positive realm, then down to $26 million in 2014, then up to $134 million in 2015, down to $9 million, and then in the negatives, and then positive for 2019. It's all over the place. We like to find companies, folks, that have consistent free cash flow as it increases over time, because that indicates to us as an investor that this company is competent in investing its free cash flow back, let's say back into itself, buying back shares, paying out dividends, operating the business in a more efficient manner. And as we discussed earlier, AMC isn't really doing that as well. Like we've been diluted as shareholders, and this currently the free cash flow is in the negatives. It's not looking too great, folks. I'm not too thrilled about where this company might be going in the future. Problem with this company is that it got hit hard during the pandemic, and it didn't help that it fell into the meme stock territory and started issuing out all these shares. Granted, what we are going to do, folks, is, as I said, find the intrinsic value of this company. So what I'm going to do, folks, is load this up in the price analysis section here, which I'm going to do a 10-year analysis. And these boxes here are just 3 different assumptions I can make: conservative, moderate, and aggressive. And what I'm going to do is use the historic numbers that have been presented to me that AMC has done in the past to try to guesstimate what this company can do going forward based off a lot of negative numbers. So stand by while I fill out these boxes. If you're enjoying the video so far, hit that like button and the subscribe button. It means a lot to me, it means a lot to the channel. So let me just show you what I've done here and click calculate on my price analysis. And here's the thing, folks. I've done conservative revenue growth numbers based off of what I've currently seen over the last 5 years. I can't really factor in this 1 year because it's incredible revenue growth. That's an anomaly because everyone's obviously so excited to go back to the movies. But I had to make sure I stay somewhat conservative. The profit margin and free cash flow margin, very difficult because a lot of negative numbers, along with the price to free cash flow as well and the PE ratio. I stuck to numbers that I think are still below 20, somewhat aggressive, but for at least the price to free cash flow and price to earnings ratio, $11, 12, and 13, based off the fact that it is 13.27 on average. It is showing 11.71 as the average calculation. What does that mean, folks? That means if you pay $11 for this company, which is currently at 4.73, it's currently undervalued and it would be a buy today. Now, here's the thing, folks. There's a little bit of a speculation here because the company has had so many negative numbers in the past. A lot of these numbers here in the free cash flow margin and profit margin, this is very much a dream scenario. You have to go in with this with the assumption of these numbers might not even be hit. 2% profit margin, free cash flow margin, because of just how inconsistent this company is. So for me, I'm staying far away from this business just because of the inconsistencies that it's shown over the last 5, let alone last couple of years. What I want to see from this company, a lot more green on this board, but they have a lot of work to do. There's share dilution. I haven't talked about it enough, but it is a killer. When you are diluting shareholders by these crazy percentages, it's not good to see. Now, if you're trading this company, an entirely different story. However, from a fundamental perspective, this is a company I would stay away from a very long time. Traders, do as much as you will. Do what you will with this company. It's a highly volatile stock, and you might be able to make your money that way. But for us value investors, I don't quite see it here. Anyways, folks, that's the video. I will see you in the next one. Write down a company you want to see analyzed in the comment section below. Along with, make sure you get this software here. Follow the links down below. 10 years of financial data plus the amazing tools that I've shown you here on the screen. So that's the video. I will see you in the next one.